After years of investing and well over 100 deals between us, my friend and guest Paul Shannon and I have learned some crucial lessons about passive investing and a handful of mistakes we're definitely not repeating. Hello, passive investors. Welcome to Passive Pockets, the passive real estate investing show. I'm your host, Jim Pfeifer. Today, Paul and I will be going over the top 9 things we do differently if we are starting out in passive real estate syndication investing so you can avoid making the same mistakes. From not asking the right questions to trusting the wrong people, we will give you all the tips on how to invest like a pro and avoid these common mistakes. Here are the top things Paul and I would do differently if we're starting over. Let's get to it. All right, Paul, we have been doing this for a while now, and so we thought it'd be great to take an episode and talk about the top things we would do differently if we were starting over. So I'm going to start with number 1, not asking the right questions. Tell us a little bit about that.
Well, typically, as you know, Jim, when you are being introduced to a sponsor, you jump on an introductory call with them. You might get a half an hour with that individual to really dive into details about their track record, their deal, just get to know them a bit. And what I was guilty of when I first got started was just kind of falling into the trap of being an extrovert and wanting to have a conversation with the person and not really having a plan going into the call, right? So one that stood out to me in particular was a guy who I felt really, comfortable talking with. They had spent some time in Indianapolis where I live. We got talking about our families in the local area. And before I knew it, we're 15 minutes into the call and I hadn't learned much of anything. And he says, in the respect of your time and mine, because I've got another call coming up here in 15 minutes, let me tell you a little bit about this deal. And I kind of let him go. And at the end of the call, I didn't have any time to ask him questions about the deal. And I didn't know much about him as an actual real estate sponsor, even though I knew he was a nice guy. I think when you go into these calls, because the time is so concise, you need to have a plan. And that's the number one thing that I do differently now is I have questions laid out. I actually wrote an article that we should link to in the show notes. I believe it's called Top 50 Questions or Essential Due Diligence Questions to Ask a Sponsor. And I pull that list up. And of course, you can't get through 50 questions in 30 minutes, but you know a little bit about the sponsor, hopefully before you get into the call, you know a little bit about the deal. So you can pull the most pertinent questions out. And I've got them kind of categorized by general questions, things about like their track record, deal level questions, specific to the actual opportunity, legal, insurance, tax questions, stuff that's pretty boring, but maybe pertinent if I'm looking for a depreciation play, for example. And then questions about the team. Who are they? Who's on the team? What role do they play in the deal, et cetera, et cetera. And it's very methodical. And I basically take control in the call. At the beginning, I say, look, I'd really like to get to know you a little bit more. I've got some really, specific questions I'd like to ask you. So in the respect of your time, Mr. Sponsor or Mrs. Sponsor, let's get right to it. So I kind of dictate the call versus them dictating it.
That's the same thing I kind of learned how to do. And at Passive Pockets, we have a sponsor screener tool. And that's basically similar to the article you wrote, right? It's like 20 questions, 30 questions. And I don't have any intention of asking all of them, as you said, but each person needs to kind of practice. And so what I did when I started out was I just started calling all kinds of operators with this sheet and just started asking them questions. And then I realized, okay, so there's some questions on there that probably don't need asked and some that I really like to ask. And so each one of us is going to have a different, fallback to which questions we like. But if you take that article and you take the Passive Pockets sponsor screener and you kind of find out which questions you want, then you have a plan for the call. And I think you nailed it. That's the most important thing. If I had to do it differently moving forward, I want to have a plan for the call and make sure I'm getting the most out of each call. So I think that's a great way to start. Screening sponsors is super important. So let's move on to number 2, right? Thinking passive investing is 100% passive. And this is the trap you fall into, right? You're an active investor. A lot of us start out that way, or you're a stock market person. And now you're like, let's get into passive. Well, that's easy, right? You just don't have to do anything. You just invest money and off you go, right?
Yeah, sure. That's great, isn't it? When the mailbox money shows up consistently, that's everybody's dream. But I think it takes some work to get to that point. And that's something that I certainly didn't realize. I was kind of allured by that phrase, passive income, dividends from stocks or income that you might earn from bonds and traditional right field investments are nice, but they're pretty paltry in comparison to what you could earn from a real estate syndication deal. But the fact of the matter is you really need to get active when it comes to passive investing on the front end. And understand that you need an education. And to get an education, you should start by reading books and listening to podcasts. reading current events about real estate to understand what's going on just in general, but in the local markets that you're interested in investing in, reading blog articles, and then taking it a step further and maybe attending conferences, shaking hands with some of the sponsors that you're potentially interested in investing with, understanding kind of the landscape and the forest through the trees. I get on LinkedIn quite a bit. I meet people through there. I can lean back on that network, whether that be LinkedIn or sometimes even Passive Pockets. It's a great place to look at and identify experiences that other LPs have had with sponsors. So really what you want to do is you want to create a deal funnel. And I've said this before, deal after deal after deal, you need to evaluate to get more comfortable with what you're looking at. And that goes from reading the documents to understanding the key metrics of the deal and how they're associated with the spreadsheet and the underwriting that the sponsors put together. And when you look at more deals, you get more confident in knowing what your risk appetite is and what you're excited about investing in. And what you should be excited about is what you understand. And you have to get that baseline education. But getting the deal funnel going is as simple as just doing all the things I recommended and, getting on these sponsors distribution lists and having your inbox full of every deal that you can see. And that's just a great way to get started as opposed to, getting excited about the first shiny object you see and jumping all in.
Right. And, thinking passive, different people look at it differently. When I first started as an active real estate investor, I thought I was passive because I bought a property and then said, hey, property manager, manage this for me. Well, I'm still the asset manager managing that property manager, and I was terrible at it. And it was a struggle and it was a constant battle. That's not passive investing. But to somebody else who has better, procedures and everything in place, maybe that is passive. I would still argue it's less passive than hiring an asset manager and having a syndication. But even that, it isn't passive because you have to do all this work ahead of time. You have to find the sponsor. You have to analyze the deal. All those things you talked about, those aren't passive. When it gets passive is you send the wire and then there's nothing you can do but hope to collect distributions and reports. That's kind of how I look at it. And I do want to mention one thing that you said. You mentioned right field, and I want to give everyone kind of the flavor of how we look at that. We used to be left field investors, and left field is where we think of like the alternative investments, syndications, real estate, things like that. Right field is kind of how we think about stock market, mutual funds, and paper assets, the standard stuff. And then center field are for people who kind of have a foot in both. And so that's kind of how through this podcast, we're going to talk about right field is kind of the standard traditional Wall Street, and left field is kind of the real estate stuff. So I think it's important, as we said, you got to understand where you are on the passive scale and where you want to be. So I want to move on to number 3. This is the most important part probably, is it's not knowing how to choose an operator, right? This is a huge learning curve. We're talking about active versus passive. This is maybe the most active you'll be, is learning how to choose an operator. So talk a little bit about that for us.
Yeah, I mean, it's an art more than a science, right? We've talked about in the past, liking and trusting a person. And I think I had those sort of backwards. I at one point was at a conference, went to a dinner that night, and I knew an individual from my local town who had started working from a sponsor in Texas. We all sat together, and I immediately had sort of that trust built with that new sponsor because my friend, the person I knew, was working for them. So they must be a good person. We had a good night that night. It was fun. I really enjoyed that sponsor's company. And the next offering he had, I decided to take a flyer and invest with him. It turned out to be one of the worst investments I made. I looked at it like, hey, this is an assumable loan. In this case, there's really no interest rate risk. Dallas is one of the hottest markets in the country. This operator has thousands of units. What could go wrong? Well, if I had taken the time to actually research who this person was and leaned on my network, like I talked about during the last question, I probably would have found out that there were a lot of unhappy investors. And most of the money that was coming in was new money, not existing investors doing multiple deals with this sponsor. So shortly after, I think I got 2 distributions. Distributions have been paused for years now, and it has nothing to do with bridge debt eroding cash flow. It has everything to do with poor due diligence on the front end, unexpected expenses, operational negligence, basically, and just not having their act together. And I think what I found out was through that experience that a lot of sponsors out there are entrepreneurs that are looking for acquisition fees on the front end. And once they earn those, their biggest portion of their compensation is hit. And if they, make their promote at the end of the hold period, that's great. That's gravy. But what they're really after is those front end fees. And it's an acquisition game more than it is an operations game for some. So I think learning that experience has helped me kind of dig deeper and not necessarily putting so much emphasis on liking the person, but actually trusting that they're capable as a fiduciary with my money. I think of them as a fiduciary, even though maybe they're not, because that money that I'm wiring them is meaningful to me. I want to know that they're probably going to break their arm themselves before they're willing to lose my capital. And whether I like them or not is sort of secondary. That's a bonus, but I don't put much emphasis there.
Let me push back on that one just a little bit on the liking the person. I agree maybe it's not the number one thing, but if I'm going to be in a deal with someone for 3, 5, 10 years, right? And I'm going to be a partner in an LP position, which means I'm part owner of that LLC, that company. I want to have at least a relationship with a person where I kind of like them, because I'm going to have to talk to them and ask them questions. If things go bad, I'm going to, I don't want to get into a deal with somebody I dislike. So I don't disagree with you, but I want to push back a little bit on that. I want to at least have someone I can have a relationship with.
Yeah, there's something to be said there for sure. I mean, it's you don't get into relationships in your personal life with people you don't like, so it should be similar. But you're not going to be talking to this person on a regular basis for the most part. If you have questions, you expect an answer in a timely fashion, but you're not hanging out with them. You're not part of the business plan necessarily. You're there for the capital piece. But I see what you're saying. Yeah, if every time you have to get in touch with them, you have a question, you get put off by their personality, probably, if you get that feeling on the front end, it's probably worth a pass no matter how good everything else looks.
True. And I also want to mention, you said you took a flyer. And I think for those that don't know Paul very well yet, take a flyer for Paul is very different than take a flyer for me. Like, take a flyer for Paul is probably, he did a lot of research and still dug into it. So I don't want people to think take a flyer is like, when I take a flyer, it's like, oh, chase the shiny object. So it's a little bit different for each person. And that's why all of this is so specific to each of us. And I want to give an example too, that, time I chose the wrong operator. It was, I tell this one all the time, but I don't want to be somebody else's guinea pig. So we're trying to choose the operator, and they did great at single family turnkey rentals in Dallas, Texas, right? But that market had dried up because houses had gotten too expensive, and that strategy didn't work anymore. So of course they went to doing small like office buildings. Well, I just figured, they're good at that. It's all real estate. They'll be good at this, right? Wrong. I lost money on that deal. And what I learned is I'm not going to be someone else's guinea pig. I'm not going to choose an operator who's great at one thing that then goes to a different thing. That makes no sense. And the other thing that I learned about operators is I get so excited. I meet somebody. I'm like, wow, they're great. I'll invest in this deal and then this deal. And then they show me another one. I'm like, I'm all in. Now I use what I call the Shirky rule after David Shirky, who's a member of our community. He does not invest or recommend somebody else invest with an operator until he has a full year with them. So he doesn't invest for the second time until he's had a full year of results for them. Now, no deal is going full cycle in a year, but at least he can see, I'm getting reports, I'm getting distributions and all of that. So I kind of like that, the way he does it.
That's a really sound approach, I think. And I've been guilty of not utilizing the Shirky rule a couple times, but that hasn't come back to bite me. All
right, so let's move on to number 4. And this one I like it. Thinking the preferred return is steady cash flow. So can you tell us what is preferred return, and then talk about this, the number 4 rule?
Again, investors get sort of enamored with this passive income idea, and they think about, man, I'm not very happy with my W-2 job. If I could just find a way to replace my income, I'd be set and I don't have to worry about working anymore, right? Let's back up to your original question. What is a preferred return? A preferred return is the amount that the sponsor must pay out in distributions as a hurdle before they take any performance compensation. Let's say it's an 8% preferred return. That sponsor needs to pay 8% accrued annually over the hold period before they earn anything, before the waterfall kicks in into the deal, the promote hits.
So every year I'm going to get 8% no matter what. That's not how it works, but that's what people think, right?
That's what it felt like, back in like 2017, 2018, when properties were producing more in the way of cash flow and hold times were shorter. That 8% preferred return was coming into the mailbox pretty frequently. But what's different about a W-2 job and your job being earning passive income from real estate syndications is that for the latter, you could take a pay cut at any moment and not know why. What happened? Wait a minute. I'm not getting that 8% anymore. Today's deals are much thinner than that. A lot of these value add multifamily deals, for example, don't pay cash flow at all in year 1 or year 2. And through the hold period of 5 years, let's call it, they might average 5 to 6% cash on cash return over that time period. So the sponsor has to make up for the shortfall at the time of exit. And that would include if there's any extra sale proceeds on top of the preferred return, you're getting that at the exit. So, you're not getting consistent cash flow necessarily. And I think The key is if you're one of those folks that's looking to create multiple income streams or replace your W-2 income, you shouldn't rely on the preferred return as the metric as far as what your cash flow would be. If you invest $100,000 in a deal and it's an 8 pref, you shouldn't count on $8,000 coming in annually every year.
The person that explained this the best to me was Brian Burke, right? He said, look, you have a business and revenue that comes in and expenses that go out are not consistent month to month. So just because you say, yeah, 8% preferred return, that means at the end, when this is all done, you will get this 8% return each year plus whatever other profits we make. But during the hold, the business should just distribute free cash flow, right? Net income, profit. That's what should be distributed. And I think people got so used to, because like you said, in the good old days, they could pay out the preferred return, but really you should just be paying out whatever extra cash is there as a business holder. And I think a lot of times operators are so concerned that they have to pay out the same amount every month. That doesn't make sense. It doesn't jive with how businesses actually operate, because in winter, maybe there's higher expenses because they're shoveling snow or whatever the issue is, there's going to be some volatility. And I think operators need to help train LPs that the income, the distributions don't need to be the same every time. And I think that's important. And I think that also ties into number 5, failing to align my investment strategy with my goals. This is one that I'm going to take on because this is the one that I was guilty of. When I first got into passive investing in syndications, I had some capital gains from sale of active real estate, right? And so I was really just focused on how can I mitigate taxes by using the lazy 1031 strategy. We're not going to talk about that here. There's an article on Passive Pockets if you want to check it out, but it's a way to avoid a regular 1031 and save on some taxes. So all I was doing was looking for investments that gave me a lot of tax loss. And a lot of those also happen to be development deals or heavy value add deals. But the problem was I didn't have a W-2. I had gone full-time passive real estate, so I needed cash flow. So the strategy I was picking didn't match the goals that I had, which was cash flow. So yeah, I'd matched that I needed to do some stuff and mitigate some taxes, but it wasn't compatible with cash flow. So what I did was I realized, okay, I have to make sure that in my investing, the bulk of what I do now is for cash flow because I still don't have a W-2. This is my main source of income. And with a smaller percentage of my portfolio, I'll still go and do some development deals and some things that might give me a higher return on the back end. They're also riskier, but I want to make sure before I do that, my cash flow, that strategy is solved and good with the investments that I'm doing. So has this been an issue with you, the alignment of your strategy with your goals? Because it certainly was for me.
Yeah, I think what you're talking about, Jim, really relates to just having a diversified portfolio of passive income.
Perfect timing, Paul, because number 6 on our list happens to be failing to prioritize a diversified investment strategy. So dive in, talk to us about diversification.
Yeah, that was something when I was first getting started. I remember my first passive investment. I had liquidated some money out of an S&P 500 ETF, and then I had allocated that into a single asset multifamily deal. And I felt like I was diversified because, oh, look, I'm in real estate now and I'm outside of the traditional market. Well, what I'd really done was sell a basket of 500 companies to trade it for one single asset that was operated by a couple people. I quickly realized that really wasn't diversification, and I needed to kind of have a better strategy moving forward. Now, it can be difficult to diversify in passive investments because there are high minimum investments, 25, 50, 100,000. And you can do some things creatively to get around those minimums, like join a tribe, for example, where you can, group invest more or less for smaller minimums and create your own LLC. I think it's a worthy cause to try to diversify. I look at it in a number of different layers. I want to diversify by sponsor. So if there's any one individual that is, having a hard time in their personal life and starts to let business go, for example, or the worst of situations happen where they're fraudulent, something like that, I want to be diversified by the people I invest in. Secondarily, I want to be diversified by asset class. For me, I was doing multifamily investments actively in my local market. So I wanted to get outside of multifamily And I also wanted to get outside of my local geography, which is another way to diversify, and participate with operators that were more seasoned in different markets that had more upside. For example, if you think about like where I live in the Midwest, it's more of a cash flow focused area, whereas areas in the Southeast, Texas, Arizona were more appreciation. There was a boom going on, a lot of population growth, a lot of potential to have your asset grow in value, but not as much cash flow. So I think that's important. You should look to diversify by property class too. Think A-class properties that are new construction versus C-class properties that maybe have been built in the 70s and have a value add component to them. In different market cycles, like the A-class property, for example, if there's a lot of supply in a market and there's difficulty in absorbing that supply from the population, those properties are going to struggle. They're going to offer concessions, their income isn't going to be as high, and they won't perform as well. They're also more prone to cap rate issues. If cap rates expand, those properties might lose value more than, let's say, a C-class property. C-class properties may have, although they have some characteristics that are likable as well, more cash flow, for example, that may dry up during recessionary periods where tenants are losing their income and can't afford to pay the bills, for example. So it's important to diversify that way. A lot of times people don't think about this, but I think it's important to diversify by maturity date on the debt. You think about the investor that maybe got really excited about passive investing in 2021 and got into a whole bunch of deals. A lot of the deals that were getting done at that point were 3-year term bridge debt, and interest rates rose over the next 3 years. And those properties are having a real hard time right now because the cash flow that the property has, they're unable to refinance and get into permanent debt.
Just think about this. If you had started in 2021 and you had said, one of the things I want to diversify is the different debt strategies that operators are doing, then that investor would not have gotten in as many bridge debt deals because they would have spent some time searching for something else. And I think that is a huge, huge key point. Sorry for interrupting, but that's just, you nailed it right there.
No, 100%. I think that's critical. And at that time, that was really everything that was going on was bridge debt, right? That was the way that these buyers were getting awarded deals because they could stretch their leverage more and pay more for the property. I always like to think about this. Bridge debt was really designed for the seller to get max proceeds, not for the buyer to acquire the property. So if you think about it in terms like that, it's really the advantage goes to the seller if the buyer uses bridge debt. And then lastly, you should think about diversification up and down the capital stack. And we could go into a whole separate episode about the capital stack, but essentially what I'm talking about is equity positions, both common and preferred equity, as well as debt, both first and second position or mezzanine. So those different positions in the capital stack are indicative of different risk profiles. So at the bottom of the capital stack is the senior debt, and those players are paid first when the property exits, so they have priority. Common equity is last to get paid, so is the most risky, and you should always be compensated for your risk. But debt will pay you income. It doesn't have some of the same characteristics as equity, like tenants paying down the note and potential for appreciation and tax benefits, etc. But if you look at a well-rounded portfolio, I think a lot of portfolios should include debt. So to sum up this piece, it's a noble cause to try to create a diversified portfolio. It may take some time, but if you go into it again with a plan and say, here's how I want my portfolio to look, you can say, okay, I've got some liquidity right now. This is the next asset class or the next part of the country or the next sponsor I want to invest with. And if you look back in 10 years, you'll see that you've got a very well-rounded strategy and portfolio.
That's one of the things, I'm not really great at goal setting and all of that. But one thing I did when I started this passive investing is every year I take a single sheet of paper and I write down, my guess for how much capital I'm going to allocate this year. And then I say, okay, my goal is going to be X number of investments in this different asset classes with this many operators, with this many different debt, and just debt strategies and other strategies. I try to plan out my diversification. I never, ever attain the goal, right? But the purpose of it is to drive my focus a little bit, to remind myself diversification is key. And I think one of the biggest things I learned from the difficult time we've been going through, right, with a difficult market, is the diversification. Because my initial plan when I first got into this was, I'm going to invest in with a bunch of different operators at the absolute minimums for 3 to 5 years. All those deals will go full cycle, and the market will just continue going up forever, so it'll be great. And I'll pick my favorite operators and then go all in with a few in each asset class. And that was my plan. And then what that turned into was, after we had all these difficulties, right, and some operators are doing well, some aren't, I was really glad that I had that strategy of all the different operators, all the different asset classes. My accountant hates me because I have too many K1s, but it really saved me. And so moving forward, I'm still going to spread out a lot, still probably invest mostly minimums until I get really confident, meaning 10 years in with an operator who has performed, and I've gone 2 or 3 times full cycle on deals with that operator, then I will increase my allocation to that operator while still kind of diversifying among everybody else. That's kind of how I'm thinking of it. How do you look at it moving forward?
Yeah, similarly to how you're looking at it, I think hold period is important too. If everything is maturing at the same time, you end up with potentially a lot of liquidity, or you end up in a scenario where interest rates are really unfavorable and you've got a lot of deals that are having a hard time, similar to debt maturity as we talked about before. But I think you always need to be thinking about liquidity too when it comes to real estate.
Number 7 is one that I certainly did, going all in with syndication real estate without thinking about liquidity. And this happened to me. Again, I told you the story when I started, I kind of didn't have my strategy straight. Well, I also was so excited because I was just leaving the financial services industry as a financial advisor, and I knew paper, assets, stock market, that was all terrible. And real estate's the only thing I wanted. And then I went active and I wanted to go passive from there. And so I just thought, well, it's real estate is real estate, active, passive, let's go for it. So I put in way too much into these syndications. And initially it was fine because everything was going full cycle in 18 months to 3 years, right? So liquidity wasn't a problem. But then the market changed. And all of a sudden these deals that have been going in 18 months to 3 years, now they're going to take 5, 7, 10 years, right? And so the liquidity issue is I don't have any control. These are long-term investments out of my control, and I can't sell them. If it was an active property where I had a single-family home and I really, really need the liquidity, I could sell the house tomorrow, not at the price I wanted, but I could get cash for it. These syndications, it is not that way. So you really need to be thinking about your liquidity and how you allocate. And you mentioned some of the debt terms, but also the term, invest in some deals that are going to go 3 years, some that are going to go 5 years, some that are going to go 7. Invest in some of the debt funds that you talked about that might have liquidity after 60 days or 90 days or a year or whatever it is. But you really need to be thinking about your liquidity. And probably I've kind of dipped back into the market because where I hold a little bit of liquidity that has a chance at return is in these paper assets that I don't like, right? But there's a use for it. So there's lots of tools. You got to figure out which tools to use when. What I do now is I really pay attention to liquidity, and I probably keep more cash than I otherwise would. I keep it in a number of different places. There's a great post in the forum where people were talking about this. Personally, I keep some cash in a HELOC because I don't have to pay for it. And it just sits there. It's kind of emergency. The cash value of my life insurance policies, that's where the bulk of my cash is. I have some in, now we can get a little bit of interest rate on these things if you just put it in a bank or a money market. And then, of course, the last place I have a little bit is the stock market. So that's kind of how I think about liquidity. Do you have anything to add to that?
I think you made a great point there. It's very well stated. I think the HELOC is a great tool for passive investors. And it's not that you want to open one and then go out and buy a boat or remodel your kitchen or buy a depreciating asset. It's an insurance policy against anything that could go wrong with these deals. Or if you have other life issues that come up and you have liquidity issues because they're all your money's locked up in these passive investments. So if you can tap a lender to open a line of credit for you and just have it there if you need it, I think it's very powerful as sort of a safety net, and you could sleep at night.
When I was talking about that in the Passive Pockets forum, somebody did push back a little bit and showed an article where some banks, if the value of your house drops, they might pull that home equity line of credit from you. So it's not foolproof, but it is something to have in your back pocket because it costs you nothing. And if you have equity in your house, just realize that it depends on the value of your home, so it could disappear. So don't put all your eggs in that basket. But as we said, we mentioned 4 or 5 different places. So I want to move on to number 8, something I'm still struggling with, not reading the private placement memorandum or PPM. Okay, this is one that I am not the greatest at. I have like 4 or 5 things I focus on, but talk to us about that. You read the PPM on every deal?
I do today. I didn't used to. And that, I think, is a mistake, right? The PPM stands for Private Placement Memorandum, and it's basically a comprehensive disclosure document highlighting all the risks of what could go wrong in your investment. So, why wouldn't you want to know those things? It's 50 pages, 100 pages maybe, so it can be really intimidating. I think if you read enough of these things, you start to know what to look for. A lot of them are boilerplate, but there's some language in there that can really catch you in specific scenarios, and you want to be aware of the risks you're taking before you get in there. So, it's basically going to highlight how money is made and how profits are paid, what fees are taken, in, most importantly, your rights as an investor. And as it relates to what's going on in the market today, I think there's no better example than how capital calls are treated. Most of the time, capital calls are not mandatory, and your equity position will get diluted if you do not participate. If everybody chose that option, the asset might be in trouble. So you have to consider that angle as well. But in an extreme case, in favor of the sponsor, if you do not participate in a capital call, you could lose your equity and rights in the asset altogether. So I think you want to kind of understand, that's just one example, understand the risks that you're taking. I'd also read the operating agreement to understand the partnership. If the organizational chart is so expansive and hard to understand, that's a red flag to me. Like, why does it have to be so complicated? Who are these other folks that are involved in this deal? And where does the money flow in the case of an issue in the deal or in the business plan? So reading all these things and highlighting questions that you have and addressing those with the sponsor, or if it's just too hard to understand, just backing away and saying, hey, all I'm looking for in these deals today is a reason to say no. And that to me is sometimes enough.
It's hard because you look at that document, you're like, you got to be kidding me. It's 100 pages long, right? But as you go through and do more and more of these, you'll get to the point where you know which parts to skip and you know which parts to focus on. And some of the stuff that I focus on is comparing what does the PPM say, what does the operating agreement say, and what does the pitch deck say? And are those all aligned? Because sometimes they're not. And that's red flags, right? You don't have to understand it like a lawyer, but you have to make sure that you're protecting your rights. And that means kind of digging in and making sure that you look at these documents and understand them and ask questions. If something looks weird, okay, great. That's just another chance for you to test the operator and say, hey, operator, do you know your own documents? And ask them, I haven't seen this before. What's up with that? So I think this is a weak point for me. I'm doing better at reading this, but as you said, you started out, you weren't really reading them. I am now much more than I was before. And it's surprising some of the things you find.
Yeah, you made a great point there. If I could just expound upon something you said about pitch decks not aligning with what's in the PPM. We just looked at a deal that was like that. An advertise, promote, waterfall structure on the pitch deck looked favorable. And then we got into the deal documents and we saw that it was a dual promote. And there was stuff that was not disclosed to us during our conversation with the sponsors. So it is very critical to look very carefully at those documents. I think when a sponsor is giving a webinar, they're trying to sell you. And you can't blame them, right? I mean, they're going to highlight why the deal is great, why they're great. And you need to kind of get past that a little bit and find out where there are holes that you can poke at.
So we're going to end on my favorite. And I'm sure if you've been listening to this podcast a while and you know me, you know it's going to be about community. So number 9, not joining a community like Passive Pockets. Talk to us about what community can do here, and then I'll add in because it is my favorite topic.
I mean, you're the man to talk to about this, but you really kind of coached me into really relying on a community as a way to ask questions of others that have had experiences that you have not, right? I mean, it's a great place to learn. Number one, if you think about Passive Pockets and all the resources that are on there as far as articles, different questions that are addressed in the forums. My favorite use of Passive Pockets is to go on there and say, hey, I'm considering investing with this sponsor. Let me do a quick search of the forums to see if anybody's had anything to say in the past about them. And it's surprising sometimes what you'll find. You're considering allocating or wiring $50,000, for example. You certainly want to know if somebody's had a bad experience and what that might have been. And is it something that you can overcome? A lot of times it's not. And it's like, okay, well, I can move on now. I'm glad I didn't spend my money or waste my money or invest in that person when they've clearly left a not so great a mark on this other individual. So you got to take things with a grain of salt and do what's right for you. But I think different perspectives are really, really helpful. And you're going to get that with a community like Passive Pockets.
And the way I look at it, when I buy something from Amazon or I buy anything online, I'm always going to the reviews, right? Just to check, is this legit? Do people like it? Do they not? That's not really a community, but it's kind of is. And with Passive Pockets, and I will caveat this, I'm obviously biased. I think Passive Pockets is the best community out there. But the key is to find a community where your personality fits in with the other people, that fits the culture of the community. So if it's not Passive Pockets, go find something else. But I don't think really that you can be successful investing in these kind of deals, syndications, without other people. Because what skills do you have that it's not like you're swinging a hammer on your own real estate deal, or you have market knowledge in Indianapolis that nobody else has, okay, then you could do active investing. But if you're doing passive investing to vet these operators, there's only a couple ways to do it. One is to invest with them, wait 5 years and see if you get your money back. And then you have one instance where that operator did a good job. Or you can rely on other people who've already invested with that operator, have experience, either 1, 2, 5, 10 years experience, people that you learn to know and like and trust because you interact with them on a daily or weekly or monthly or annual basis. You meet them in person at the meetups, you talk to them in the forums, you're on the Zoom calls. There's just so many ways to network. And the other thing is, nobody else does this, right? You can't walk out your front door and talk to your neighbors and be like, hey, what are you guys doing in these real estate syndications? They're going to think you're nuts. They're going to want to talk about their IRA or 401k because that's finance to them. So finding a community, for me, it is the number one thing that has made me a better investor, hands down. And I've gotten more out of the community probably than anyone because I get to have, be on the podcast and talk to people like you and also talk to a lot of members. But, joining a community, I think that is just a unique and essential way to become a better investor. So there's no place better to wrap than that. Paul, do you have anything to add?
No, I think you nailed it. It's been fun to talk about this today.
That's a wrap on today's episode. A big thank you to my guest and friend, Paul Shannon, for sharing valuable insights on how to avoid common mistakes in passive real estate investing, from asking the right questions to ensuring proper diversification. If you're looking to elevate your investing journey, be sure to join Passive Pockets to connect, learn, and grow, and take advantage of the 7-day free trial. Don't forget to like this episode and leave a comment on what you wish you knew earlier in your investing career. For more information, check out the related article on Passive Pockets website. Thanks for tuning in. Happy investing.